2025 from rupees 1400 per share, indicating an upside of 11% from current levels. And it's on the back of positive surprise that Kotak Institutional Equities is expecting in US sales. It says company is well poised to surprise positively on street estimates in the US in FY 25-26, and US sales will surprise positively despite baking in a sharp decline in albuterol sales over next 2 years. And company has a bunch of products lined up to ensure limited earnings dip in FY 27 after strong FY 26. And on the back of this, Kotak has raised FY 25-27 EPS estimates by 3 to 16%. So keep an eye on Lupin.
All right, we will do that. So thanks very much for that. You know, this double upgrade, we'll talk about that.
The double upgrades.
But 24,340 is where the Nifty is starting at. We got the market open on our hands, and I think we got the sensex, which is up 0.25%, 80,152. So these are good start. I mean, it's not a 95, 100-point startup, but I like that. I mean, it's, 100-point start, and then you wonder how much more. But 50-point start, you can imagine, one being up a little bit more from there. So 24,341, 345 on the Nifty. You got the sensex, which is 80,170. And I think the bank Nifty is on your screen. It's up about 70 points. We're at about 53,164 on the Nifty bank. So these are sort of first rates on indices, but it's all about stocks. So let's get this rolling.
Absolutely. Well, the one that's cooling off is actually HDFC Bank. That's the reason why the Bank Nifty is not fired up too much after yesterday's up move. But the other banks are actually doing quite okay. ICICI Bank is the leader on the Nifty right now, 1.5% on the higher side. Axis is finding some green as well. Bajaj Finance is the big one to look at, and that update is looking great. 31% growth in the AUM. The street likes that, but it's not getting a very huge, thumping, resounding up move. It's a more measured 0.5% gain that we've got going on it. Some of the IT stocks are really supportive. So that's good news for the index. HCL Tech, TCS, and Lupin, the double upgrade that Sud was just telling us about. That's working well for Lupin. So it's a good-looking screen. You've got some auto stocks like M&M that are finding more traction. IT, as I said, is positive. Banks beyond HDFC Bank are positive, and Lupin is reacting very well to that upgrade that's come in from Kotak Institutional Equities, 0.25% higher on the index. That's pretty much it. I mean, Shriram Finance is cooling off, but it's had a fantastic run. So there's a bit of a cool-off that's evident today. Kaya, look at that. That's what I think Mangalam was indicating, that forget Marico. For Marico, it's just, okay, they're selling one more set of products. But for Kaya, they're getting a massive distribution reach with this tie-up with Marico. That's a stock 10% higher.
Well, that's right. A few more names that are moving up. ITD Cementation, as we said earlier, the stock has already run up, anticipating some news. The stock was up 35% in the last 1 month or so. The promoter entity now has come out and said we could potentially look to divest our stake. For the time being, the stock is down closer to around 3%. Why is that? The promoter entity itself, their balance sheet isn't in great shape. You have the stock that ran up 35% in 1 month, and the market capitalization is 10,000 crores. Even if you assume that their profitability goes from 270 to 470 crores, it's not cheap, trading at more than 20 times odds. So ITD Cementation has seen some profit taking today. Kaya, as you said, Marico will handle the sales and marketing of Kaya 75 products outside Kaya Clinic. So, that has the potential to unlock some untapped growth potential of the brand. So that's another stock that's moved up. Suraj Estates, the stock is now up close to around 6%. In the last 1 month or so, the stock has moved from around the 350 mark to around 550 mark. Nuvama has come out with a note, and they are quite positive on the stock. So explains why that one's up close to around 7%. Cello World, well, they have a QIP that they have announced, as Abhishek told us, source-based information. So that one as well is flying away in today's trading session. Good-looking screen, but the Nifty Bank is a relative underperformer because it seems yesterday HDFC Bank has hit a bit of a near-term peak at around that 1,800 rupees odd mark. Near-term peak would be a little bit of a harsh word, but it seems some bit of resistance at higher levels after the kind of run that we've seen.
No, just one more stock to mention, Walkard. Yesterday it was up 7%. This is really something you can't ignore. Again this morning, 6.5%. I'm not sure what's happening. No immediate reported corporate development, but
there was that molecule. I think Ekta had interviewed. I think it was Mr. Habil Khorakiwala recently, a couple of days back. And there's that molecule which is, the reports are that it is doing very well.
It's met the primary endpoint, the first stage of, I think.
It's apparently very meaningful, and that's a trigger. So from 600 rupees late June, it's now at about 950. So that's the extent of the move that we've seen. One-way move on Walkard. Look at the volumes as well. Almost 500,000 shares traded this morning. What else? So Inox Wind is up 5% this morning. I think it did well yesterday. Stocks is at about 150 rupees. There is Skipper Limited, which is up about 4%, 383 on Skipper. There is GE T&D, which is up 5%. I think that's a daily circuit. Voltamp is up about 2 1/3. So some sort of, flavor in terms of that power theme starting to come back. Can't be very far away. Skipper, I think we mentioned 5 1/4%, 5 1/3% higher at this stage. Of course, the biggest volume-led gainer is Hoodco with a 5% pop. So that continues its sort of one-way, uninterrupted move that we've been tracking. On the way down, I think a few other names apart from HDFC and ITD, which we discussed. GM Breweries had a blistering rally and is down about 4%. Just pullbacks, basically. D-Link India, again, blistering one-way rally, about a 4% pullback this morning. Shakti Pumps, more than a blistering rally. It's down about 5%, 40-50 on Shakti Pumps. Exicom is down about 1%. Gujarat Gas is down about 1%. M&M Finance is down about 3/4. Astral is down about 1.25%. Avas Financial is down about 1% as well. So, we're just starting with many of these stocks. Volumes are a little thin, but I'm sure they'll pick up. It's been a very, very vibrant screen with the large volume-led gains across the board. We'll welcome in Ashwini Agarwal now. He's founder and partner at Demeter Advisors. Ashwini, always a pleasure having you with us here on CNBC-TV18. Thank you for your time. The markets continuing to rally on, Ashwini. And let's just start with power as a space. And what would you advise viewers to buy? Because the fundamentals are there. When we approach a sector like power, which was down in the dumps, it takes a lot longer for people at large to get convinced, right? Well, this is the real deal. But we had the Bernstein analyst with us yesterday who was talking to us about how there is a real need to add twice the capacity over the next couple of years than what was added over the last few years. And a lot of the ordering will take place with Indian companies here. A lot of the financing will be met by Indian companies. Just your thoughts here, Ashwini.
Morning, Prashant. Thank you for having me here. So you rightly pointed out that, this is a sector which was down in the dumps, and it's taken a while for people to kind of realize that there is a real opportunity out here. And I think what many of us miss is the fact that the amount of time we all spend on social media or looking at our Instagram pages or Facebook, whatever else you're doing, YouTube videos and so on and so forth. And these engines, they're trying to curate the content for you using artificial intelligence engines that in the background. All of this consumes a whole bunch of power. And the data centers in the United States already account for, I'm told, about 8% of the power consumed in the United States. And I would imagine that it would be no different from what will happen in India, or what's probably already happening in India. So obviously the demand for electricity is growing at a very rapid clip in India, in addition to connectivity that has been brought about by the government, and demands for air conditioning, home appliances, and what have you. So yes, it's a situation. We all missed it, or at least I can say I missed it 3 years ago, 4 years ago, to look at this broad trend. So, and your question is, what does one do now? I think, maybe some of the large utilities is a way where valuations still appear to be okay, but in a lot of the distribution space or distribution infrastructure, machine manufacturers, in my view, are now trading at multiples which are kind of very demanding in my perspective. So I think, I'm looking at the past saying I missed it, but I'm not likely to do anything about them at this point. Because valuations are quite punchy. Yes, there'll be earnings growth, but we must remember that, at the end of the day, when you're paying a very high multiple, you're paying for multiple years of cash flow, and you're paying a fancy exit, a multiple as well, beyond your visible horizon of 3 years or 5 years. And these are cyclical asset creators. So, you might have a very good run for 3 or 4 years. And after that, what the question will arise again. So, momentum is there with good reason, but I'm not the one to participate here.
Okay. I guess it takes a brave heart to say that in this market, Ashwini. Great to be speaking with you. Because it's a complete out-and-out, good morning, it's an out-and-out momentum market, right? And that's what we've had for several months, in fact, over a year now. So, okay, maybe you're not going to ride this power wave or, some of these high flyers, but then what else? Where else would you? Because the thing with this market is that wherever there is relative value, those pockets have been testing investors' patience. Whether it is, let's say, FMCG stocks or even banks up till recently. So what are you looking at?
So, Surabhi, great question. And, let's go back to, the two big bull markets in my lifetime, at least, which is 2000, 2008, and partly, let's say, 2017. Okay. Now, in 2000 rally, if you had purchased, any of the industrials or any of the banks, even as the IT stocks were having a roaring bull run, you would have come out way ahead on a 3-year basis or a 5-year basis. Okay, if you look at the returns between even 99 to 2004, forget 2000 to 2004, you would have come out ahead if you had bet against the crowd. Similarly, in 2007, which is a year before the market peaked, if you had bought pharmaceuticals and consumer names, you would have come out way ahead on a 3 to 5-year basis. What I'm trying to say, and it's in a very, it's how at least I think, that it's very important to kind of let go of what is trendy and what has momentum and look for value. And value lies in cash flows and value lies in relative valuations. So this is the time to actually be buying large caps. Like you mentioned, several of the banks have barely done anything. A lot of the insurance companies have barely done anything. And these valuations are reasonable. I mean, they're not expensive. These are market leaders generating a ton of cash. So, why not buy these companies? There is bottom-up opportunity in several industrial areas, in consumer stocks on a bottom-up basis, which look good. Pharmaceutical, healthcare looks good. So all I'm saying is that, look, when the market is in such a frenzy, you've got to do two things. One is look for out-of-favor large caps, market leaders. And number two is dig deeper, but be very careful where valuations on a historical basis are trading at significantly above long-term median historical numbers. That's what I would say.
All right. Hi, Ashwini. Good morning. Good to see you.
Morning,
that's an interesting point you make. What about the other large cap part of the index? That is the IT space. Suddenly you're getting these sound bites that maybe Q1 is going to be the quarter from where we see an uptrend. There's plenty of interest and the stocks are not trading particularly cheap. If I get the number correct, the IT index itself, all the stocks out there, they're trading at around 28 times, which is a 20% premium in comparison to what they've traded on, say, for the last 5 years or so. And it's at a big premium in comparison to what the Nifty is trading at as well. But your view on the tech space, there seems to be plenty of interest out there and the street is bracing for positive surprises.
So, Nigel, I've been watching the IT sector for the last 2 years, hoping to build a conviction to be able to buy. But each quarter has come and gone, and I haven't been able to build the conviction. I mean, if you read between the lines, the amount of effort it takes to grow revenues and to grow margins is just stupendous, and it's not happening. It's happening in a few pockets, maybe 1 or 2 stocks. And it's happening in the smaller companies, but it's not happening with the leaders at all. So I'll wait to see what this quarter delivers and if the commentary meaningfully changes. Like you pointed out, the stocks are not cheap, they're expensive. And growth is not for certain. So if growth is not visible and I'm being asked to pay multiples which are higher than what they have prevailed on a 10-year basis or a 20-year basis, then I question if that's the fair thing to do. So as of now, I'm out. We'll be watching the June quarter results with a great amount of interest, as I have done over the last 8 quarters, and found that I should stay away. Let's see what happens.
I would. So the question is, what do you like, or do you like cash right now?
No.
Ashwini.
Prashant, like I said, okay, look for frontline. There is opportunity in banks. There is opportunity in insurance companies, both in general and life. There is opportunity in pharmaceuticals, healthcare. There's opportunity in a whole bunch of mid and small caps, but you got to dig deeper. All I'm saying is that what the 2000 and 2008 crash have taught me is that if there is a certain bubble forming in a certain area of the marketplace, you can never say how large the bubble is going to get. But you are better off out early than waiting for the top. That's all that I'm saying. So I'm saying that, look, I'm not the one to be investing in power or energy or defense or railways at this point in time. But there are other opportunities. So, yeah, I mean, one does have some cash allocation in the portfolio as always. But it's something out of ordinary right now because, the whole environment is quite positive for India. So to expect that the market will correct and everything is very expensive, that's not fair. That's not right. But there are pockets, and I think I'm quite candid in sharing, where I find those pockets.
You use the B word, Ashwini, the B word, bubble, right?
Yes.
I think most people are very hesitant in using that. It's been, kind of circling in my own head as I look at the market because I don't think in our careers, I'm sure Prashant would concur that in our careers that we've seen this kind of domestic money pumping in the market on a daily basis, right? So I don't know, when we talk about risks ahead for the market, and I don't want to be a bear over here, but just asking the question, is there a domestic liquidity bubble in the making, and is that a risk?
Yeah, that could be a risk. Surbhi, if you go back and look at the history of markets in Japan and the markets in the United States, when 401k started to participate in the equity market, it led to decadal long bull run. Similarly, in Japan, and valuations became really, really expensive before they fell off. So I don't know how large this bubble will get. So you're right. I mean, there is domestic investor, there is demand from provident funds, from retirement funds, from pension funds, from insurance companies. Even if investors are not directly allocating, even where investors are not directly allocating, their savings are being put to work in the equity market via these indirect assets that they own or they have a right to receive in the future. So you're right. There is a huge amount of money flow, but we are also starting to see a fair amount of paper flow. Earlier in the show, you were talking about ITD cementation. I don't have the stock, I don't own the name, but it's interesting that the promoters want to sell shares. Over the last week, you see the number of block deals that have happened where private equity players, promoters, and various other people have sold down because, markets are expensive, even in their view, because they must be looking at their own business saying, look, it's not worth what the market is willing to pay for it from a long-term perspective. So we are better off taking some cash home, de-risking, or whatever you call it. So my point is exactly the same. My point is that, yes, there is a huge amount of liquidity flow, and we cannot, for the life of us, estimate how long this will continue and how high the market will go. But on a relative basis, the only sensible way, in my view, to play this is to buy areas which are not expensive, which will participate in the economic growth. But, you're staying with market leaders, you're staying with somewhat out of favor stocks. So, if the chips were to fall, you hurt less. That's all.
All right, Ashwini, thanks a lot for stopping by and filling us in with your take on the markets as well as stocks and sectors that you do like. Well, time to move on then. Let's focus on Eicher Motors. The company reported double-digit growth in the CV sales. Do note that this is the second consecutive month of higher sales. To discuss the demand, the trends on ground, we're joined by Mr. Vinod Agarwal, the MD and CEO of Volvo Eicher Commercial Vehicles. Hi, Mr. Agarwal. Good morning, and thanks a lot for joining in. Well, tell us about this growth. It's looking quite good. Double digit is what you've done. For the remainder of this year, what kind of a number can you guide? Are you looking at mid double digit? Is it going to be low double digit or high double digit growth in terms of volumes? And are you outpacing the industry? If yes, by how much?
No, if you look at our track record, for last few years, we have been outpacing the industry consistently. So our strategy is to continue to outpace the industry. And the reason for outpacing is that we have a very strong product line and our network is becoming stronger and stronger. Now, the second thing is how the industry situation. As far as the commercial vehicle industry is concerned, I would say first 3 months of this year have not been as good as we would have liked it to be. However, going forward, my expectation is that the industry will do well because now the stable government is in place, and there are continuation of all the economic policies. That's what it looks like. Now we are looking forward to the budget, and we expect that the investments in infrastructure will continue to remain strong, and there is very strong replacement demand lined up. As of now, the customers want to replace, but for the time being, even though they are holding up little bit because of the monsoons, therefore we are expecting that the industry will definitely do very well starting from September onwards, and then festive season, and we are expecting good monsoon. Rural economy also is expected to do well. So therefore, overall CV industry, we are expecting it will do well in the balance part of the year. And of course, our strategy will continue to do better than the industry.
So what does the industry grow by then, sir? You know, you said that you would like quarter 1 to be better, but you're optimistic that things improve from here on. So what's the industry growth then that you're working with?
Hopefully, it should be double digit or near double digit, or you can say a little bit higher than the double digit.
Okay, and you will grow at what? 1.2, 1.3, 1.5 times what the market grows?
No, it's very difficult to give the exact number, but it is wise to say that our strategy is always to do better because we have a lot of room for growth. If you look at the heavy-duty trucks, our market share is still around 9% only. So it's a huge market, and there is a huge room for growth for us.
You know, Mr. Agarwal, hi, sir. Morning, Surabhi here. When I saw your numbers, I double-checked. I read them again. And the reason is that you're the first among your peers to show this kind of growth on the CV side. None of the other companies, Tata Motors, Ashok Leyland, all of them have been either absolutely flat or slightly lower. So which is why I just want to go back to the basics and try and understand where the growth is coming from. I mean, is it from certain regions, which is the state or which is the segment? Just trying to understand if this is a flash in the pan or if this is sustainable. Give us some more color on ground on you know, what's gone into this June number and what makes you confident.
If you look into the segments, I think currently the buses segment is doing extremely well. Overall, bus industry, it has grown in first quarter by 35%. The second big growth is coming from exports. Exports seem to have bottomed out now. As you know, till last year end, the exports were dropping significantly, and as compared to the earlier peak of 18-19. But this year, quarter 1, the exports have gone up by 31% as far as the overall industry is concerned. Our exports growth has been more than 50% in first quarter. So we have done relatively better in exports. We are doing well in buses, even though our bus industry growth is little bit lower than the industry. But overall, we are doing very well in bus segment also. If you look at the heavy-duty trucks and light and medium-duty trucks, there the growth rates are very, very subdued. Their heavy-duty trucks are almost flat. There is not much growth. That's why I was saying quarter 1 is not as good as we had expected it to be. Similarly, light and medium-duty trucks also, there has been very, very marginal growth for quarter 1. So we expect that these heavy-duty trucks and light and medium-duty trucks, they will grow much better in the balance part of the year, especially from September onwards. So as far as we are concerned, we have done better.
Why do you feel that, sir? Why do you feel that? Because that's been the industry's Achilles heel. Heavy trucks and even medium-duty trucks, they're simply not picking up. The heavy-duty commercial vehicles, despite the fact that this is a very vibrant economy, right? Economic growth, there's no complaint over there. So what makes you confident that things will change from September?
I think the fundamental is the economic growth. If all of us believe that the economy is growing, and the economy last year has grown by 8% plus, and this year also all the projections are that it will grow 7 to 8%. And if you believe in that the government is going to spend 11 lakh crores in infrastructure, then if the infrastructure spend happens, then you need trucks. So therefore, the tippers, construction trucks, heavy-duty trucks, and better roads, then migration to the tractor segment.
Sure.
That will be good. So it's fundamental factor.
So just to come back to your own business, you said that in the first quarter, your exports have done very well, and that's where the growth is coming in from. So as a percentage of the total business, how much were exports in FY24 and how much will they be in this year, FY25? And also what impact does that have on your margin? Because in Q4, your margins had come down. I mean, year on year, there was a drop in margin. So now with exports picking up, I just want to understand how that affects the margin profile.
Exports overall still are much lower because with the drop in the overall export segment till last year, the exports, which used to be around 15% of our turnover, last year it dropped to almost 5 to 7%. And now from that low base, it has started growing. So therefore, I would not say that the exports are still contributing the large numbers. Large numbers are still coming from heavy-duty trucks and light and medium-duty trucks and buses. But of course, it's a good thing that the exports also have started growing. As far as the margins are concerned, we have rightly said we are at a EBITDA margin of around 8% last year, and our objective is to improve on that, and we are working on it.
All right, let's get a couple of numbers going then, sir. You know, your exports have grown, as you mentioned, and you're quite candid about that. In the last year, if I look at the financial year, actually exports were down 24-25% on a year-on-year basis. Absolutely. And now on that low base, it's seeing a recovery. And so on that low base, what kind of a growth can you see? The previous year, you did around 4,900 units. For the last year, you did around 3,700 units. So on 3,700 units, could we see a growth of at least around 50%, or does it double? Because it's a very, very low base and the first quarter has done well. So what do you end this year?
First quarter growth is 50% plus.
Yes.
If you look at the Bangladesh market, market has started growing. Nepal also has started growing. And Sri Lanka, we are expecting that after elections in October, there should be positive traction. They will lift the ban on import of trucks. Middle East is growing very well. Africa is also growing. So therefore, all export markets where India is exporting, I think they are expected to do better. So therefore, we would expect very strong double-digit growth in the full year.
No, double digits, sir. That's going to be you're being very conservative there.
So it's very difficult to
should we work, sir? Sir, should we work with the number of closer around 6,000 units for the year? You did 5,000 in FY23. So for the year,
at the peak level, we were at 10,000.
Correct. Correct.
Yes, so reach 10,000. So that's what our objective is. 10,000, we have to first reach 10,000. Then, of course, we have to grow much beyond 10,000. That's our aim. Long-term goal.
And 10,000 in FY25 or FY26?
Let's hope that it happens faster.
Okay.
So that's on exports. Now let's combine it with the overall business, domestic business as well, which is, like you're saying, bus demand is good. So given that things are looking up and the first quarter has gone down well, give us a picture for the full financial year in terms of total volume growth, top line growth, and you just told us that you're looking to improve margins this year. By how much?
Look, first, if you look at the numbers, last year we had sold 85,560 full year.
Yes.
Which is growth of 7.5% as against industry growth of 3.9%. So last year we were all-time high, and this year quarter one we are doing well, and then hopefully we will grow on 85,560. So there, of course, it's anybody's guess. It can be near double digit or more than double digit. So it will depend how much the industry grows. As I mentioned, we are expecting the industry to grow by a double digit. If industry grows by double digit, we should do better than that. And that will be the growth on overall 85,560 of last year. As far as the margins are concerned, the good thing is there is a lot of, you can say, the industry is conscious that the discounts are not good for the industry, and everyone is working on it. Everyone is trying to cut down the discounts, which is a good sign. And we are also working on how to improve the price management, how to do the value selling. So with that, our aim will be to continue to improve the price management. And based on that, of course, the margins should improve. How much it will improve, it is very difficult to say.
But so the aspiration, like, I mean, you mentioned that you're going to try, but how much it will happen, we can't say. But what is it that you're aspiring for? 100 basis points, 200 basis points? What's the target range?
Mr. Agarwal, just to add, Mr. Agarwal, last year you improved by around 50 basis points. It was at around 8%, that compares with around 7.5%. So you think that you can replicate that because the growth is going to be a little bit better than the 7.5% that you did last year. So do you think another 50 basis points would be par for the course, give and take everything?
That there will be operating leverage because when the
Yes.
volume goes up, the fixed costs don't go up in the same ratio. So
Yes.
therefore, there will be some improvement because of the operating leverage itself. And then there will, if we are on top of it, if we are able to do better price management, then I think the margins should do better than last year. I will not
All right.
like to put a number on it, but of course,
Okay.
the objective is to do better.
Okay, and you gave us the number for heavy duty trucks. I think your market share is around 9% that you mentioned.
Yes.
What about on buses?
On buses, in light and medium duty buses, we are at around 25%.
25%.
And in bigger buses, we are still at around 8-9% only.
Okay. All right, sir. Great conversation. But before we let you go, we are running up to a very important event. All eyes on the budget in July. So what is on your wish list for the finance minister?
Of course, we are expecting that the focus on infrastructure investments will become even stronger. In the interim budget, the allocation was 11.1 lakh crores. We are expecting that that should even go up further. The second expectation is that there should be some boost to the rural economy because if you look at entry-level passenger cars or entry-level two-wheelers, there has been stress in that, and that entry-level demand comes from the rural markets. So we expect that there should be some boost to the rural economy so that rural consumers, they start coming back more and more. And with good monsoon or better monsoon this year, hopefully rural economy should do better. So therefore, we are expecting the government should focus on the rural economy more. And then, of course, we are expecting that there should be more, you can say, incentives for the electric vehicles because migration to electric vehicles is very important. As of now, migration is happening, but it is very slow. So therefore, some continuation of the incentive scheme like FAME 3 or any other incentive, we are expecting that there will be incentives on the electric vehicles and there will be some incentive on the scrappage of vehicles. Because as of now, the scrappage scheme is there, but of course, to work it effectively, I think some incentive is required from the government so that the scrappage scheme works effectively. So that's what our wish list from the fiscal budget.
All right, we'll leave it there, sir. Good speaking with you, Mr. Agarwal, and we'll chat again. Appreciate you joining in here with a lot of that perspective. I just want to take a look at the market now, which is rallied to the high point of the day. We are up 100 plus points. And this is, what we were talking about in the morning, right at word go. When you start with a 100-point gap up, you're left wondering what next. But when you start with a more modest 40, 50-point gap up like today, I mean, you can see the market heading a little bit more higher. And that is exactly what we've done from where we started. So 24,384, very close to 24,400 now. And there is, significant follow through after yesterday's breakout. Yesterday's price action was important because we took out this resistance zone in a decisive kind of a way. Lots of newer stocks into the mix as well. Mazgaon Dock, like clockwork, by about 10 o'clock, Mazgaon Dock occupies the first position with volume-led gains. So Mazgaon at about 49.19 is the number one volume-led gainer right now, and it's followed by Cochin Shipyard. So the shipbuilders, are on a rocket. 7% in Cochin Shipyard as well, 2,600 plus. Coming through there. Hudco is still there. It's just been relegated to the number 3 position in terms of volume-led gains. There is Skipper, which is up 6%, very large volumes. 390 on Skipper, 6.25% gains. Atul Auto has had a fantastic last few days. Atul Auto is up another 4.5% right now. There's a small name. I mean, they do basically animation works for a lot of Hollywood studios, etc. I'm talking about Prime Focus, based out of Mumbai. 15% on Prime Focus. Stocks at about 155. I'm not sure what's going on, if there is any news flow or something, but it's really been a stock which has not done anything for years. So coming up with volumes for this point right now. And then what else? I mean, you go down the list, there's more stuff, but then volumes are a little lacking. Suraj Estates, I think we mentioned that in the morning. 6.5%, 7% gains there. So this is the bulk of the big volume-led gainers, and a lot of these names are new. They were not in the mix at 9:15 when we sort of looked at what everything is doing. ITD is now down a full 7.25%. ITD cementation, that's at about 533 coming through. Policy Bazaar, I mean, one common thing across the board, of course, is what is down is basically all down because, there's been a very sharp run-up in a very short time span. But otherwise, I mean, there's not very much volume on what is going down. I can spot 5 or 6 names which have got decent-sized volumes. One of them is HDFC, the other is ITD, GM Breweries. Apollo Tyres is down 1.5% on some volumes. I mentioned Policy Bazaar. There is Bharti Hexacom, which is down about 1.6, 1.7% as well. But that's about it. That's a short list of, decent volume-led losers as well. We'll take a quick commercial break here. We'll come back and we'll continue talking about markets, but we'll also have a special exclusive conversation with the MD CEO at Star Health, the largest standalone health insurer, and that's coming up in just a bit from now.
Welcome back. Well, let's turn our attention to Star Health Insurance, and the company expects doubling of its gross written premium in the next 4 years. They also aim to have the largest health insurance book. In fact, my colleague Yash Chen caught up with Anand Roy, the MD and CEO of Star Health Insurance. Let's listen in to what he had to say.
We have guided for a doubling of our GWP in the next 4 years' time, from 15,000 crores to 30,000 crores. We took 17 years to get to 15,000 crores. We hope to get to 30,000 crores in the next 4 years' time. The ask is that the company has to grow at 18% year-on-year CAGR, which is the ask to get to this number in the next 4 years' time. We have delivered that performance in the past, and we believe that the strategies that we have in place should be able to deliver that numbers in the future also. So as we speak, for the current financial year, we have a target of around 18,000 crores that we have set for ourselves, as against 15,250 crores, which is a 18% CAGR.
What is the kind of growth that you expect on the retail side? What would be on the group side? Just to understand that which portfolio will deliver in a stronger way to the number that you're speaking about.
Absolutely, and Star has been known in the market for its retail franchise. We have created a lot of in-depth retail distribution as well as products and the customer base. So retail will continue to be our key growth driver. We are not going to lose our focus from that. But having said that, we look at group as a great opportunity where we are not significantly present right now. And we believe that, there is a long headroom for play in that segment for us. So we have evaluated the group business, and we see that, the small and medium enterprises, the SME segment is a sweet spot where we believe that, we have the distribution, the service capabilities, and that is the area that we would like to focus on. So currently, retail to group, our the mix is 92% retail and 8% group. We would believe that as we go forward in the next 4 years' time, it will slightly shift towards maybe an 85 to 15 or an 80-20 kind of a mix. This year we hope to get to around at least 1,000 crores in group business. Last year we did little lesser than 500 crores, and by the end of 4 years we should be at least 4x that. We should grow at 100% every year after that.
For FY25, where do you expect your combined ratios to be? And since you're speaking about the next 4 years till FY28, What will be the guidance that you would want to give the street on the combined ratio side?
Yeah. So this year we are guiding, I would not say guiding, we are aspiring internally to improve our combined ratio by 100 basis points this year. And we believe that that improvement will come from, both a mix of operating expenses as well as on the claims expenses, So we expect a 50 basis point improvement in both OPEX and claims.
Okay.
That's what we are, targeting for this year. As we go forward, Star Health actually has the best expenses of ratio management in the entire SAHI space, at least so to speak. And with the technology investments that we have made and with the productivity improvements that we expect to achieve, I think our OPEX ratios will keep coming down by 50 bips every year rather.
Correct.
And we hope to add that to our overall combined ratio improvements as we go forward. Yeah.
Okay, so about 200 basis points in 4 years.
Yes.
And about 50 basis points in FY25 itself for reduction. Okay, now I want to take the reference of how the company performed in the fourth quarter and understand a few things. If you look at the monthly numbers also on the premium collection, Star's numbers and the industry average, there's been a difference of about 100 basis points or 10%. If you're growing at 18%, the industry is growing at 28%, similarly with those numbers. What I want to understand from you is that with the kind of size and the base which Star Health has, should one assume this difference of about 100 basis points to continue, or would you actually look to close this gap also with the industry average going forward, and how soon going forward would that happen?
So we aspire to grow faster than the general insurance industry, okay? And that's our internal aspiration, where we believe that the industry should grow at maybe mid-teens and we should grow at 18% and that's our aspiration.
This 10% difference, since you say that we don't want to chase growth blindly, would that continue?
Absolutely. And see, you have to look at the scale of business. When we were at that scale of 5,000, 6,000 crores, we were also growing at 30-40%. Okay, so today the scale of business, today Star Health is actually number 7 in the overall general insurance pecking order. If you take out the 4 PSU companies, we are actually number 3. And we are doing a monoline business. All others are doing general insurance business. So I think, we have reached a scale which is substantial, and to grow at that scale with a reasonable and profitable, model is something that we want to achieve.
How soon do you, expect yourself to have the biggest health insurance portfolio in the whole sector?
I think, the way we are growing and the opportunity which exists in the market, I think we should be able to get there sooner rather than later. I would not like to put a timeline to that, but I think the 4-year agenda that we have set for ourselves, I think we will achieve that, that's what we are trying to see.
If you look at the numbers for FY24, the underwriting performance as well as the operating performance both suffered. Your underwriting performance was down by about 50% on a year-on-year basis, FY24. Same was the case with the operating profitability. What is coming in the way of you improving your underwriting and operating profitability? And do you expect a turnaround on both these parameters in FY25?
Absolutely, we expect a turnaround, and as I've told you, we expect that both of these parameters on loss ratio as well as on the OPEX, we are going to improve by 50 bips. On the underwriting side, see, we one of our large products, we took a price correction, okay, and that price correction, for it to play out, it takes about 24 months time, and I think so that will reflect in this year's performance.
Okay.
But I think, at an underwriting level, the company is very focused on making sure that, the company is profitable, and we have actually taken some calls to exit some businesses where we were seeing that the underwriting performance is not up to the mark. In certain markets, we went slow, and that is why we sacrificed a few basis points in terms of market share. But that was done strategically to make the company more robust for the future, rather than, taking those loss-making segments forever.
Life insurance was something that looked very interesting to you. Do you still hold that view of seeing life insurance industry as a attractive space for Star Health Insurance? Once approved, let's say composite insurance license, how long would it take for you to enter that market and roll out your product? And third question, when you enter into life insurance, would you only focus on selling protection products, because that's something which will complement your current business in the best way possible?
Yeah, absolutely, Yash. The discussion on composite has been going on for a long time now, and we believe that, it is coming to some level of maturity now, and let's see how quickly it comes to the market. But we are keeping our powder dry, right? We want to be prepared for whenever this new regime comes into play. We have had our internal strategies and internal discussions and surveys done with our distributors, with our team members and all of that. We believe that the protection model of life insurance is something which is a very close adjacency to our business. We hope, I don't want to give a number to that, but I think we should be the first to go to market with the product.
Another question related to composite insurance license. Would you apply for a fresh license with the regulator, or would you look at acquiring a company which already has a license and has certain amount of business and distribution?
It's a good question, and this is something that we are discussing. Of course, we'll have to discuss with our promoters on these strategies. We are in the talks right now, but we will let you know at the right time, Yash. I think it's too early to comment on that right now.
All right, well, that's the management of Star Health in an exclusive conversation with my colleague Yash Jain. We'll take a quick commercial break here. But on the other side, we'll have Ramdev Agarwal, Chairman of Motilal Oswal Financial Services, with us. A couple of years back, he told us that the sensex will be at 1 lakh. Yesterday, we hit 80,000, so he's going to up his targets. So that's a conversation coming up after a quick break. Stay with us.
SEBI and all, they are going by what panel is saying. The issue is that try to understand what are the incentives.
Welcome back. 100 points higher on the Nifty, and we are basically making new milestones. So let's talk to somebody who's seen many milestones. I mean, yesterday I was saying that when I started reporting on markets, the sensex was at 5,000 levels. We are 16x from that point on. But I think we have somebody who's seen, markets since pretty much inception in the current modern format. We have Ramdev Agarwal, Chairman and Co-founder at Motilal Oswal Financial Services, right here in our studios. Ramdev, great to have you with us here. Thank you very much for your time.
Very good morning.
It is a very good morning, right? Yes. Every day is a good morning nowadays.
80,300.
Last, a couple of years back, you told us sensex 1 lakh. We are at 80,000. We bridged the gap.
Yeah.
So we need a bigger target. When you come up closer, you need a bigger number.
So you give me longer way. I mean, what has happened after 10 years, I'll give you a much bigger number. So, it's just a compounding. See, I started my career when it was 100.
Yeah.
So, 1980 only I bought my first stock, and that time sensex got started at 100. Today is 80,000. Do you know what is the rate of compounding in 44 years? Guess.
20%.
No. This is what is all about compounding. It's 16.4%.
Yeah. Okay.
Year after year, for 44 years, I have seen this market growing at.
Compound.
I didn't know that it's 16%. I thought it was 15%. This is a 15% country. India is a 15% country. So I have seen, I mean, like every 5 years it doubles. Like from 40,000 to 80,000, it has become in 5 years, exact. So it's about 15%. And longer term is also 15, 16%. So there is no reason to believe that going forward it will be anything significantly different. It might become 14. It might become 16. So if you go at 15, I mean, let's keep the base rate 15. In 5 years flat, 2029, you will be 1,60,000. You know, is that a big enough number, or we should double it again?
I want to just, so you take a slightly longer sweep of time, and that's the way to do it. You even out and iron out a lot of the fluctuation and volatility. And I think you put that out beautifully with that sort of example. But slightly near term, this is also the fastest 10,000 point move. Now, of course, I mean, from going from 70 to 80 in percentage terms is very different from going to 10 to 20. I mean, so having said that, this has come in about 130, 140 days. This last 10,000 points. So is it just your thoughts?
But you can have a deep correction up to 2,000 points, and then it will get nullified in the sense that, see, what happens is the base effect comes. Say first 10,000 to from 10,000 to 20,000 is a doubler.
Correct.
Obviously, it will take 5 years. But 70 to 80,000 is just about 14%.
15%, yes.
So 14% and 100%, it is going to take different times.
No, but the other aspect, we've been discussing this, is this whole liquidity gush, right? This massive tap of domestic liquidity, which is why this is a very different market from, where we were maybe 10 years ago or 15 years ago. Does this worry you, that there's so much money chasing stocks? Is that in itself maybe a risk that people don't want to look at?
No, why worry you? It's the happiest situation in my 40 years of career.
Okay.
Yeah, it is the happiest situation. When actually retail, which is, see, in 1.4 billion people, at least we should have 500 million people in the market. We still have only 160 billion or 100 billion. So this journey of inclusive development of the markets, because the risk capital is going to come from, not from the top end of the population. Risk capital will come in a truly distributed way from across the country. And that is the revolution which is on. Say 3,000 rupees SIP, 5,000 rupees SIP. So the guy who is giving, say, my household servant or somebody, he or she doesn't realize, I mean, for her also it is very small. Say she is contributing, say, something like 35,000 rupees a year. If that goes down by 20-30%, I don't think she is aware of it. And it really matters to her. But that 30,000 rupees all collected in the SIP becoming 22,000 crores per month, means about 240,000 crores, 2.5 lakh crores per year. This entire thing is available to our entrepreneurs.
Actually, the average SIP size, I think, is about under 3,000 rupees.
Yeah,
so it is very, very small.
So what I'm saying is, risk is distributed. The best thing to happen in any equity market is when the risk is distributed. The whole concept of joint stock company came as to distribute the risk. So this is the ultimate form of distribution of risk, and that's how our quality of equity capital, which is available to my entrepreneurs, finally, the corporates, is very high quality.
No, but that's at a much broader sort of thematic level, and I couldn't agree with you more. It is a revolution that we're witnessing right here in our lifetimes. But just in the near term, in the short term, given the pace of money coming in mutual funds and the fact that the spectrum of stocks, and also there are definitions and regulations, right? So the spectrum of stocks, your basket is pretty much the same. So is that a challenge?
No, you are seeing a lot of supplies coming in. From existing promoters and FIs. FIs have been supplying for last 1.5, 2 years. Now they also seem to be tired. Now it is all for the new companies which are not listed. So 100% owned unlisted company, they are coming with the IPO. Almost every day there is 1 or 2 IPOs. I think it will be a record year of maybe 200 IPOs or at least 160, 170 IPOs. Almost every other day you will close 1 IPO. And there is no season in the sense that entire 365 days it is open, which is a very different change. So supply line is building up. The good thing about the market, India, is that there are 3,000-4,000 companies listed already, and they all can use a lot of money. as the demand builds up for their respective products and services. So I think there is a lot of demand, and then on top of it, the owners are there who are sitting on 52% of the ownership. So they wouldn't mind shelling out 10% of their holding to the retail public. Now 10% means, see, today market cap of the market is about 440 lakh crores. 10% means 44 lakhs. My flow is just about 6 lakh crores. So if entire thing has to come from existing, if you raise the prices too much, the existing owners of the companies, they will supply you 10%, which is good enough for next 5 years. So there is no dearth of supply. Samsung will come, government of Singapore will come, Jio will come.
Hyundai is coming.
Hyundai is coming. Everybody will come. There is, see, if you sell a rupee stuff for 1 rupee 20 paisa, 125 or 150, supply will come. You should have that faith that somewhere it will come. In what form it will come? Existing, new, old, and it has a tremendous impact on the private equity, venture capital, the appetite for unlisted. Appetite for unlisted is so high, and that is where the money is going into the startup of new companies, you know. Unheard of cities, you know, you go to tier 3, tier 4, there's so much of excitement about becoming corporate, getting organized, wanting to do private equity, wanting to do, kind of public issue, which is what is the revolution. I'm not so much about the 80,000 and all. That is what is the reflection and fun for us. But actually, what is the second order effect of really, it's like a water, Ganges water coming to desert of Rajasthan. See, immediately it might create flood, but eventually 10 years henceforth, entire Rajasthan would become green.
Wow.
That's the effect which this will have.
Hi Ramdev, good to see you. And I'm just doing the back of the envelope calculation, 80,000, 1,50,000 in the next 10 years. When my kids go to high school, it will be at around 3 lakhs. I'm quite pleased with that thought. But I wanted to ask you this, given the kind of participation you're seeing and the revolution that we're seeing, do you think it's time that we see some kind of participation in either house of the parliament, from either the brokerage community, the stock market community, because the participation is there. We're going through a revolution. Do you think that's the time has come?
I think we should have at least one state cabinet minister for capital markets. Reporting to the main FM, there should be one dedicated, and he should have office in Mumbai rather than Delhi. It is very important that his office is open. I think SEBI is doing that job more or less. But still, I mean, at a political level, because SEBI also reports into, I think, president or something like that. But at political base also, there should be somebody who is fully dedicated, listening to the voice and concerns, ideas, opportunities. Because, see, capital market opportunities is amazing. Only US has this very vibrant capital market. Okay. And that's why US is what US is. So India today with $5 trillion plus kind of market cap, we can be in 5 years flat. See, your market cap index grows at 15%, but market cap grows at about 17-18%.
Yeah,
because of new issuance and all.
Yes.
So 18% means in 4 years flat you'll be $10 trillion. You just think of $10 trillion market, and the entire market, fortunately and unfortunately, is just in South Bombay, south of Bombay, south of Bandra. So you imagine what kind of intensive activity you're going to see in this city.
And I'll tell you, I mean, I was talking to a gentleman who heads a large sort of SME portfolio at a large bank. And he travels and meets companies in tier 2, tier 3 cities, etc. Everyone wants to raise money.
Yeah.
Everyone is thinking of doing an equity issuance. And it's an incredible pipe. Companies we've never heard of.
Yes, yes.
These are, small size, 100, 200, 300, 500 crores, up to 1,000 crores essentially. But it's a big pipeline of companies which we will see over the next couple of years. Although, Ramdev, sometimes, having seen markets a long time, you sometimes wonder, is this really happening in this size and scale? And I think that is natural to wonder sometimes.
Yeah, for me also it's first time. In the sense that we have seen the markets going up and down. It doesn't go down now.
Yeah.
See, every time, like in 2000, I think real fun was 2003 to after 9/11 collapse in 2001. It was kind of depressed. Motilal also incurred loss for 2-3 months. So that was a bit of cautionary time. But after that, from 2003 to 2007, it was amazing time. But this was a global boom. You go to US, you go to China. I mean, when I used to go to Hong Kong and used to open the newspaper, I said, "Hamare yahan boom hai, yahan to super boom hai." Like the headlines were so different. We were growing at 15-20%, they were going at 40-50%. Now they are growing at 5-10%, we are going at 25-30%. So this is truly India decade. We got to play it very, very cautiously, I'm telling you. Particularly the capital market card.
Yeah.
Because it is not understood properly.
And let's talk about that.
Yeah.
And I think at that time retail investors were not, I mean, they were
Yeah.
nowhere, maybe,
Yeah.
you know,
We
what
should
the
do
size. It
nothing
was
to
completely
disturb this.
FII driven.
Otherwise they'll go to gold.
With our SIPs and our first funds, I remember back then.
They will go to gold, I'm telling you. Or they'll go to real estate, which is again a mess.
So
all the savings must come here.
So what do you mean by that when you say you got to play it carefully in terms of, I think what you mean is regulations, etc.
Yeah, no, they have, see, our regulators have done amazing job.
Yeah.
I'm telling you, this boom is bigger than 92 boom. Just that in 92 there was no SEBI. So today we have SEBI, we have RBI, we have digital tracking, we have everything perfect. But just that, you know, because unless something is broken, don't fix it. My sense is that something is.
So what is your fear? Let's approach it from the other side.
My fear is that they should not do anything, you know, which can disturb this tempo of shift of savings from, say, now it is happening from bank deposits to, say, mutual funds. You know, this is a wonderful thing. Now they should not do anything whereby the other asset class like gold, which is unproductive, you know, people should not become, by mistake, they should not make gold or real estate investing or some cash-based assets buying more attractive compared to stocks.
And who's the they? Are you referring to regulators or the government?
I mean, power that be. I mean, I'm not pointing out anybody because a lot of people have a lot of powers. RBI has its own power, SEBI has another power, government of course has a lot of lawmaking powers. I mean, all that, you know, fiscal measures like your capital gains and all those kind of stuff. Then this side monetary is there. Isko paisa nahi dena, usko paisa nahi dena. Ye band kar do, wo band kar do. Then SEBI is saying. So, मैं क्या बोल रहा हूँ कि see, they have done so far. They only have brought it here. So all the credit to them. But having got it here, don't get scared of what you designed for when they are coming.
Yeah.
See, you designed for the inclusive development of the capital market. That's truly happening. Till the complaint comes from the consumers themselves. You know, I mean.
So before we start talking markets here and now, just to complete this point, you know, tell us about the budget. We're talking about not fixing what isn't broken, right? That's what you're saying.
I would confine
from a capital market perspective, because that's one big fear. There'll be some tax change, there'll be some capital gains change.
Yeah, so that's where.
So what's your wish list when you want to?
I have.
Don't spoil
no
the
change is the best thing. No change is the best thing. But actually, they should make it even more attractive for the people, not for me. I don't want any tax concession for sure. But the masses, I mean, wherever it pains, say like, say PMS people are doing. So PMS, you know, I mean, that's not a budget issue. I mean, that is all for the maybe SEBI or somebody to reform. But wherever little points are there, in terms of fraction with the, I mean, with the development of capital market, you know, say taxation issue. This taxation is always a big pain point, you know, like, say pass through hota hai. First they will say this is a pass through, this particular category is pass through, and then later on they say 10 years back it was pass through, but as per this is not pass through, and hence you get into litigation, and that litigation never gets over. So, you know, one is that of course some mistake could be committed by the intermediaries, but I think there should be an extremely good settlement system out of the court settlement system. Okay, we go and accept this happened, but looking back it is a mistake, but today, okay, let's sit across and pay some fine or something and settle it and done and dusted types. You know, so that we can move on. Otherwise, there are 2 chart accounts, consultants, and people are busy. You keep issuing notices. So I think it must be made very, very fraction free. The capital market should be the most friendliest capital market in the world should be India.
So completing the loop on the budget. Yeah. You're saying no changes. That's
broadly,
from a taxation perspective.
It should not be changing. Yeah, I think we are in a very good equilibrium.
Yeah. So. Anything, just to complete that thing on the budget, anything else you are expecting, not just capital market, from a budget? Will it be a big one? Because this is the first time we will hear about them talking about...
I would expect that there should be some boost to the consumption. See, you want private capex. Government is doing all the bits of its... you see the GST number of this month. It is 7.7% growth. If this trend continues and it goes to 6% and 5%, then you have a problem in the health. Because your GDP is growing at 10-12%, your GST is growing at 7%. It means it is only first month. So let's not because it was at the middle of the election and super heat wave. It should recover hopefully next month itself. But if it doesn't recover, there is a problem with the consumption. So you have to address to the consumption. They will have all the high frequency data, not with me, and they have all the super economists. They will say how to build this up. Because the moment consumption is there, Indian enterprises are so smart. You want burgers, people will supply 1,000 types of burgers. You want cars, people will, you see, you don't have to tell anybody, all kinds of cars are coming here. So you have to just give indication where the consumption is and investment will come. Because infrastructure is something which only government can do.
So some income tax relief for something like that on, I mean, should, you're saying that should do?
There are two ways. One is that put more money in the hands of the poor guys or not poor.
The salaried people.
Let's say rural.
Non-urban. Tax-paying people.
Tax-paying people. You put more money. The guys who are not paying tax, in any case, you have no control on them. The guys who are paying tax, you can reduce that, like I would say, up to 12 lakhs. No tax. I'm a farmer. No tax till 12 lakhs. Matlab he should not know where is the income tax office like. 12 lakhs rupees means a lakh rupees.
You know, this is a first. This is the first time I'm hearing someone who's a veteran of the capital markets saying it'll be okay if you go to that dramatic extent, saying no income tax till
5 lakh to hai na. See, 5 lakh hai.
वो तो अभी की exemption limit है. Yes.
झंझट है ना कि भी आपका वो 10,000 रुपए का आने का है, 5,000 जाने का, and full income tax department filled with all these cases.
Yeah.
Millions of cases going on. आप 12 lakh तक साफ कर दो. So income tax officer has relationship only with the guys who are earning actually 12 lakhs plus. तो आपका पूरा population साफ है.
This is a mindset change, sir, because usually the moment something like this would happen, the market would fall saying, oh, this is a very populist measure, it's a very populist government.
Market, देखिए, you cannot build budget for market.
Yeah.
Market has its own mind.
Yeah.
Okay. जिस दिन बाजार आएगा उस दिन यदि FI ने $20 billion बेच दिया कोई कारण से, तो आप कितना भी अच्छा बाजार लाओ खराब हो जाएगा बाजार. So forget about the market. No, you can't run it for the market. You have to run it for what is good for the country.
Absolutely.
You know, Ramdev, similar time, exactly 1 month ago, we were speaking when the market was 3,000 points lower from here. Shows the kind of recovery that we've seen in the market and the power of retail as well. But since you briefly mentioned mass, I wanted your take on the mass segment. Are we coming to the end of the K-shaped recovery that we saw? And there's plenty of demand for stocks. But are we seeing demand now for shoes, for soaps? Is that coming back?
No.
Is there recovery on the cards or not yet?
No, in fact, it's slowing down. What I see, I keep getting bits and pieces of news. But today morning, I was talking to 1 or 2 businessmen. They are saying that like one shoemaker has gone half, he has retained half of the staff because there's no demand for the good quality shoes. So maybe it is going to some foreign brand or something. But per se, there is no, 8% GDP growth for 2 years. And still there is no boom in HUL, Nestle and Marico and Britannia. People they should not be able to punch enough biscuits for 8% growth economy.
Now, let's run through a few other things.
Yeah.
Capital market plays. It's been a long-standing theme of yours.
Yeah.
Does it stays absolutely rock solid?
It becomes even bigger.
Bigger.
Let's see budget what
all these transaction charges and all that what happened recently.
They're all passing. See, nobody is trying. Authorities are not touching the customers. They are making only the wrong incentive which is there for the intermediaries to expand the volumes big time so that they can get their credits. They have simply stopped the credits. So now intermediaries will respond in whatever possible way. Maybe they will increase the charges or
so it will get through. It will be tidied over. It's just
part of the developmental process.
Okay, private financials.
Yeah.
What's the view now? I mean, because that's private financials, private banks.
Yeah.
Banks actually, financials.
Yeah,
You've been a big bull, and HDFC Bank, I mean, there was a bit of a trigger there as well.
Yeah.
What's the view from here?
My sense is they're going to do very well because this is the best time for the banking. What is happening with so much of equity coming into the corporate world, the quality of credit given to the entire corporate world has significantly improved. And the prepayments and the quality of corporate cash flow is so good that banks don't have to worry about the corporate book, which is almost 50% of any bank. MSME aap jodoge to it might work out 65-70%. So that portion of the lending, which is bulk of the lending for banks, is fantastic, and the quality is improving day by day. You know, so clearly banks are in very good shape. The only problem they have is the liability issue, in the sense that if you have 15, 16, 70% credit growth, you need that much growth in the deposits also. And deposit growth is very calibrated, and 11-12%. So their cost of deposits are going up. So I don't know how. RBI is clearly on top of it, and they have a lot of tools to provide as much liquidity they want. So I'm sure
they'll another sector I wanted to, because there's a fund, the defense fund, the Motilal Oswal Defence Fund. Has it started
Yeah, I think
deploying?
from yesterday it started trading.
Stocks are higher today. I mean, I can see
Again
some
higher?
of that. No, I'm just saying.
I
maybe
don't
they
know.
deploy.
I mean, but see, they're done. I think yesterday was the first day, so I don't know whether fully it is done, but it gets listed.
But you know, how do you view this space? Some of these stocks are up 10, 15 times. So one school of thought would be, now it's, you know, we are starting for the next 5, 10 years because it's got a tremendous runway. The other school of thought will be like, these stocks already went up so much. So give us the rationale. I mean, on a space like defense, which has done so well, and now you'll come out with an NFO.
Yeah. So see, all the PSUs, they were discarded for, I would say, 10 to 12 years or maybe 15 years. They literally came to zero performance 3 years back in our wealth creation study. And so it is making up for the last 15 years of lost valuation. I mean, things came from, say, 12, 13, 15 P multiple to 2, 3, 4, I mean, low single digit P multiples. Like quality, I don't know, even now it was a single digit.
Yeah, 8 and a half.
Yeah, so it was, this is despite doubling, so it was 3, 4 P multiple. Your HPP house is still at about 5, 6 P multiple or 7 P multiple. So clearly, the PSUs were depressed beyond anybody's imagination, and now under this government, I think the PSU profit performance is also very good. All the PSU banks which were in dire straits, absolutely, till COVID, post-COVID they have come back, they cleaned up the book in COVID, and now they are as profitable as private sector.
And if I got the number right, I think the entire PSU basket you're getting 15 lakh crore, which has gone to around 70 lakh crore. But the good news is the profitability as well has gone up as much. So on a PE basis, it's not still that's not changed.
The area is power, Ramdevji. Power as a space, utilities and equipment makers and financiers. Do you like that space as a fund house, or you think it's a bit overdone now?
There is a lot of choice, but yeah, I mean, see, it all depends on the stock. See, I'm not anymore picking stocks, you know, and so I'm not at liberty to talk to you about individual stocks. But the opportunity is there for any company which has a solid business model and the desire to grow. You know, I mean, some of these PSU financing companies, all the private power sector capital expenditure which is coming up, a lot of it will go from their books.
You know, but on a related note, because of this kind of expansion, if you look at the industrial space overall, which has worked so well, right? It's become a high, it used to be a value play, now it's like the high momentum play in the market, where stocks like ABB and Siemens, they're trading at 80 times, 90 times, 100 times forward multiples. How should investors approach it? I mean, thematically, yes, we understand, but so when you see these prices...
Yeah, there will always be some segment of the market which you don't understand or I don't understand. If you don't understand, don't bother about them. Because they're enough to play some other place.
But overall, when you talk capex, industrials, what's
so
your
they are
view?
the highest quality capex companies, Siemens, ABB and all, because they have very long-term franchise. It's not, you know, one season here and there. They are the guys who have, first thing is, they're not very capital intensive. They're much more software driven, services driven. They have IPR, what they do, nobody else can do it. So second, as the India goes from say 4 trillion to 8 trillion, your size of the capex boom will be 3x, not 2x. So who are the guys? There is nobody, no substitute coming for them. So they are going to get more complex, bigger orders in their books. So, and then ROE is very high. Their margins are now from 8-9%, they are at 14-15%. So everything is going well for them. And even globally, now the parent company, if you see these companies, European companies, total setup, India is the only place from where they are getting this 25-30% growth. And now it has become significant in size. And more than the operations, market cap has become significant in their size. A lot of people, they are selling here to buy back in their parent organization. So now they cannot ignore, because this is a, India as a powerhouse. You know, this is a decade for India. And it will be on the back of a lot of this capex, which will be helping them big time.
All right, Ramdev, just one final word. You know, we have spoken about consumption, about capex. The other C is cement, and you have spoken about this in the past as well. The consolidation drive is picking up steam, and I've got my ear to the ground. I believe there's a couple of assets that will get gobbled up in the next 6-8 months or so. You've spoken about this in the past. How do you approach that theme? With the large are getting larger, the smaller ones are getting a better parentage. So how do you approach that? Because clearly this is a space that is seeing plenty of interest, a new player coming in there, and you've seen plenty of consolidation.
Yeah, so this is a very funny situation where consolidation is on, and yet new players are entering. So there's no dearth of supply of the capacity. You know, so there has to be genuine shortage of cement, which is not happening. And this we are counting for last 24 years. That demand is going to go up at this pace, supply is going to be constant like this, and hence there is going to be a big bang price increase.
Yeah.
So that has not happened, and I don't see it happening in near future.
So how do you approach the theme then?
Yeah, so stay. I mean, if the stock is available at replacement cost of below $100, buy. If it is $150, $200, sell.
Right, well, that's straightforward. Ramdev, great to have you with us here. Really appreciate it.
Nice.
So 1,60,000 sensex by 2029. 29.
5 years, doubling
five
every 5
years.
years.
That
That's
long.
the formula.
2034, we're at 3 lakh.
All right, I'm just kidding, but wonderful chat as always. Thank you very much for being with us here. So that's Ramdev Agarwal, Motilal Oswal Financial Services, with his thoughts on the market. It's a wrap on this edition of Bazaar and that special conversation. We are back with Chartbusters on the other side. Stay tuned.